Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Dan Boyd, Senior Energy Analyst at Mizuho Americas, to discuss ESG strategies and investments being made in the energy sector and the impact that they have to all different types of companies within the space. Dan, it's great to see you again. Welcome back to Trade Talks.
Hi, thanks, Jill. Good to see you again as well.
And Dan, what is the impact the energy transition is having on oil E&Ps, refiners, the majors?
I mean, the impact is really massive. If you think about it, energy is going from a cyclical growth sector to a value sector. And that requires a completely different strategy. It has one of low cost, free cash flow, and minimal growth. The industry is mature. We can see the sunset on the horizon. We think that is 10 to 15 years away. So we think there is plenty of growth in the near term, but that is resulting in a different strategy of lower supply, lower growth. And that's actually one of the reasons why you see oil prices where they are today. The Saudis know it. I mean, oil could go to 80 tomorrow, and the shale producers aren't going to react. And so that is a consequence of the energy transition.
What's the importance of capital discipline and cash return strategies to regain broader investor participation?
I mean, that's everything. If you look at oil and gas and you see it as a mature industry, you want to get as much cash today as possible. And so you're seeing the companies that are deploying that strategy of capital discipline, returning cash, those are the stocks that are outperforming. You look at the S&P 500, the dividend yield today is about 1.5%. Most of the energy companies that we cover on the majors are in the mid-single digit range. The Europeans are actually a little bit higher. And US E&Ps have gone from having really almost no dividends to now having a competitive, and the large caps actually having a premium of around a 2% dividend yield. So we think that is the key to oil and gas regaining relevance with investors.
And tell us about ESG strategies and investments being made to reduce environmental footprint while lowering costs and enhancing returns.
Yeah, so and you're seeing two different strategies being deployed. In Europe, there is a strategy of also being very directly involved in power generation. On the US side, we're seeing a different strategy. It is more around lowering your own emissions. It is reducing flaring, and it is trying to invest in things where you have a competitive advantage within your business already. And the one thing that's really starting to stand out is carbon capture, carbon management. Exxon highlighted it at their investor day a couple of weeks ago. And you're looking at a business that could end up being a $1 to $2 trillion industry. And if you look at our sector, the large caps are doing it. But Oxy is the one that really stands out as looking to be a carbon management company in the future, in addition to producing hydrocarbons.
What's the importance of scale in a lower growth macro with ESG pressures and the role of M&A going forward?
I mean, it's everything, right? When you think about a mature value industry, it is about being the low cost producer, and it is about having the very best prospects. And that's what M&A allows you to do. You can high grade all of their different investment opportunities. You can reduce costs, but it also helps you navigate a changing regulatory environment. So we look for M&A to continue to play a critical role in the transition, and we've seen quite a bit of M&A already.
All right, Dan, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Absolutely. Thank you.